You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
Imagine finding out that the tool that just gave your retirement portfolio this massive 14% boost is, fundamentally hallucinating a third of the time.
It's a completely wild concept to wrap your head around.
Right. Welcome to today's deep dive. We are looking at this crazy financial landscape in 2026, where the shiny new tool is, of course, artificial intelligence.
And our mission today is really to just cut through all that deafening marketing noise.
Exactly. We want to answer one massive question for you. Can AI investing apps actually help you beat the market? Or is this all just, glossy hype designed to quietly separate you from your money?
Which is a very real possibility. We have this massive stack of sources in front of us today. We're talking comprehensive beginner guides, deep cut 2026 app reviews, and a ton of independent testing data.
And looking through all this, the data presents a severe, almost impossible contradiction. And we have to resolve this before you even think about, connecting your bank account to one of these platforms.
Yeah, let's put this paradox right on the table immediately, because the numbers, they feel like they belong to two completely different technologies.
They really do. So we have this concrete data from 2024 showing that every day, do-it-yourself investors, people who use dedicated AI investing tools, they earned an average of 14% higher annual returns than the folks who just stuck to manual research.
Right. And a 14% outperformance, that is a life-changing delta when you apply compound interest over a decade.
It's massive. But then, on the flip side of that exact same coin, independent testing reveals that when general AI chatbots were asked just basic finance questions, they gave wrong, misleading, or completely fabricated answers roughly 35% of the time.
Over a third of the time, the machine is literally just confidently making things up.
Yes. So if the machine is failing a basic finance quiz 1 out of every 3 times, how is it simultaneously generating a 14% boost in actual real-world portfolios?
It's a huge disconnect.
It is. It must not be making the trades at all.
Right.
It must be doing something completely different behind the scenes, right?
You hit the nail on the head. The outperformance, it doesn't come from the AI acting as some sort of crystal ball. It's not, picking the next hidden meme stock or perfectly timing a market bottom.
So what is it doing? Because when I hear 14% boost, my brain immediately pictures a supercomputer scanning the matrix for a stock that is guaranteed to go up.
Right, that's the marketing fantasy. But to understand that 14% number, you have to look past the algorithm and look directly at human psychology. The boost is actually a byproduct of behavioral finance.
Walk me through the mechanics of that. You're saying the AI is basically just fixing our own bad habits.
Precisely. Decades of behavioral finance data demonstrate that human biases, specifically overconfidence and loss aversion, they are the absolute destroyers of self-directed portfolios.
Oh, totally. We are our own worst enemies.
Exactly. We have studies in the sources showing retail investors wipe out as much as 3 full percentage points of their own potential annual returns. And that's simply by making emotional decisions.
Okay, give me a real-world example of how someone casually destroys 3% of their own money. How does that actually happen on Tuesday?
Okay, picture a scenario where a company you own stock in misses their quarterly earnings estimate by, say, 2 cents per share.
Barely a miss.
Right, a tiny miss. But the stock price instantly drops 6% in after-hours trading. Your heart rate spikes.
Naturally.
And loss aversion kicks in. This is the psychological phenomenon where the pain of losing money feels roughly twice as intense as the joy of making that exact same amount.
Oh, wow. Twice as intense.
Yeah. So you panic, you assume the company's going bankrupt, and you hit the sell all button just to stop the bleeding.
Just to make the bad feeling go away.
Exactly. But 2 days later, the market digests the news, realizes the underlying business is completely fine, and the stock bounces right back up to where it was.
But I'm no longer in the stock. So I locked in that 6% loss permanently.
You locked it in. You panic sold the bottom. Or, conversely, you experience extreme FOMO fear of missing out, and you buy into a trending tech stock at the absolute peak of a hype cycle.
Because my neighbor won't stop talking about it at a barbecue.
Right, and these self-inflicted wounds, they compound over time.
Okay, so if the AI isn't this magical fortune teller handing me the winning lottery numbers, it sounds more like a financial personal trainer.
I like that.
Like someone who just stands next to me and physically slaps a donut out of my hand when I'm about to ruin my diet.
That is the perfect analogy. The AI enforces discipline. When that stock drops 6% and your human instinct is to panic, the AI doesn't have a heart rate. It doesn't feel fear.
It's just lines of code.
Right.
Yeah.
It looks at the parameters you established when you were calm, it cross-references historical volatility data, and it essentially overrides your panic.
It saves you from yourself.
It does. It might automatically harvest tax losses or rebalance your asset allocation, but the key is it prevents you from making the emotional trade. That automated discipline is what recaptures that 3% penalty. It raises your floor rather than magically raising your ceiling.
I want to stop on that term for a second, tax loss harvesting, because I see that thrown around constantly in these app reviews as this major selling point.
It is a massive selling point.
What is that mechanically? Are you just selling losers to offset taxes on winners?
At a fundamental level, yes. If you sell a stock for a $5,000 profit, the government is going to tax you on that capital gain.
Right. The IRS always gets their cut.
Always.
Yeah.
But if you have another stock in your portfolio that is currently down by $5,000, you can sell that losing stock to offset your gain. You realize the loss, bringing your taxable profit to zero.
Okay, but then I don't own that stock anymore. What if it goes back up?
Well, that is where the IRS wash sale rule comes in. You cannot claim the tax deduction if you buy that exact same stock back within 30 days.
So I can't just sell it on Monday and buy it back on Tuesday to get the tax break.
Exactly. And doing this manually is a complete nightmare for a normal person. You have to track the dates, the specific tax lots, and remember to buy back in on day 31.
I can barely remember to take the trash out on Tuesdays.
Right. So an AI platform does this constantly in the background. It sells the losing stock, instantly buys a highly correlated proxy-like, say, an ETF in the exact same sector, so you maintain your market exposure for 30 days.
Oh, that's clever.
And then it swaps it back. It is a relentless, tedious optimization process that no human wants to sit at a spreadsheet and do, but it mathematically generates extra money in your pocket at tax time.
Okay, I'm really starting to see how the 14% comes together now. It's not one giant heroic trade like in the movie.
No, not at all.
It's just the aggregation of hundreds of tiny, unemotional optimizations that I would either completely forget to do or be too scared to execute.
That's exactly what it is.
But the AI is doing more than just babysitting our emotions and doing our taxes. Let's look at the data ingestion aspect, because the sheer scale of information in modern markets is honestly incomprehensible.
It really is. Consider this single statistic from our sources. Global listed companies release over 700,000 PDF pages of earnings material every single quarter.
700,000 pages.
Yeah.
Every quarter. I read that in the notes and couldn't even process the scale.
It's too much for the human brain.
Yeah. I mean, if I had a team of 50 Wall Street analysts locked in a room drinking nothing but espresso, they couldn't read a fraction of that before the market moved. How does a machine actually read a PDF and turn it into a trading decision?
It utilizes natural language processing, or NLP. The AI doesn't read the way you and I do. It scans the text and assigns sentiment scores to specific phrasing.
What does that look like in practice?
Well, for instance, if a CEO is speaking on an earnings call and uses the phrase supply chain headwinds or macroeconomic softening, the NLP model immediately flags that as negative sentiment.
Even though it sounds like corporate jargon.
Right. It's corporate speak for we are losing money. And the AI compares the frequency of those cautious words to the exact language the company used in previous quarters.
Oh, so it's tracking the change in tone over time.
Exactly. If the CEO sounds 10% more pessimistic than they did 3 months ago, the AI factors that into a massive matrix of other data points. It looks at current interest rates, commodity prices, historical stock performance following similar language.
So it's quantifying human speech into a mathematical risk score in, what, milliseconds?
Yes, milliseconds. Along with pulling in SEC filings, global news sentiment, and supply chain shipping data, it monitors this 24/7. It can auto-rebalance your asset allocation the second your portfolio drifts off target. It is a processing engine of unprecedented scale.
But, okay, we need to pump the brakes here for a second and give you, the listener, a serious reality check. Because when you describe a machine reading 700,000 pages and quantifying a CEO's tone of voice, it sounds basically invincible.
It does sound like magic, but it's not.
Right. What are the hard boundaries? What can these AI apps absolutely not do?
They cannot remove underlying market risk. That's the biggest one.
Explain that.
If you are fully invested in the stock market and the entire global economy enters a severe recession, an AI investing app is going to lose money right alongside everyone else. The algorithm cannot magically generate positive returns out of thin air when every single asset class is declining.
So it's not a shield against gravity. If the market tanks, you tank.
Far from it.
Right.
You tank with it. And perhaps more importantly, an AI cannot fix a fundamentally broken financial strategy.
Meaning what, exactly?
Meaning, if your primary goal is to treat the stock market like a casino, chasing whatever microcap penny stock is trending on a social media forum today, an AI tool is simply going to help you lose your money faster and more efficiently.
Oh, man. So if you program the AI to day trade meme stocks, it's going to ruthlessly day trade meme stocks until your account goes to zero.
It will execute your terrible plan with perfect machine-like precision. The tool works for your goals, not the other way around. If you are a conservative investor who loses sleep over a 5% drawdown, you need a conservative mix of bonds and blue-chip stocks.
You don't need a hyperactive algorithm trying to scalp options.
Exactly. You do not need a hyperactive AI algorithm trying to trade momentum options. The AI is your co-pilot, but you are sitting in the captain's chair and you have to file the flight plan.
Which perfectly brings us to the actual tools on the market right now.
Mm-hmm.
If you are going to hire one of these co-pilots, you really have to know what specific job you are hiring them to do.
That is crucial.
Because reading through these sources, the biggest mistake people make is confusing the different categories. They download a deep research tool and expect it to, automatically day trade for them while they're at work.
Mixing up the taxonomy is probably the most dangerous misconception in the 2026 landscape. We can break the entire ecosystem down into 3 distinct flavors to save you from information overload. Understanding the fundamental mechanics of each flavor is critical to protecting your capital.
Okay, let's do the breakdown. Flavor number 1, the research platforms.
Right.
The goal here is making better decisions. These tools investigate questions. They look into the fundamentals of a company, the technical chart levels, SEC Form 4 insider trading data, or what the 13F super investors are doing.
Yes.
But the crucial distinction here is that the output of a research platform is a thesis. It does not execute the trade for you.
They compile the evidence and present an argument. You mentioned 13F filings and Form 4s. Let's explain why an AI is so valuable for analyzing those specific documents, because they are historically very difficult for retail investors to actually utilize.
Yeah, please do.
Yeah.
Because if I'm a beginner, a 13F filing just sounds like boring tax paperwork. What is it and why do I even care?
So a 13F is a quarterly report filed by institutional investment managers who control over $100 million in qualifying assets.
So the big fish.
The massive fish. It essentially forces the biggest players in the world, people like Warren Buffett, Ray Dalio, or huge hedge funds, to publicly disclose their stock holdings.
Okay, wait. So I can literally look at what the billionaires are buying and just copy them.
In theory, yes. But here is the catch, and this is where the AI becomes necessary. Those filings are legally allowed to be delayed by up to 45 days after the end of the quarter.
Oh, wow. 45 days.
Yeah. So by the time a human reads the 13F and sees that Warren Buffett bought a specific bank stock, that information is a month and a half old. The market has already moved. The big money has already been made.
Ah, so the edge is completely gone.
The edge is severely blunted. But a research AI doesn't just look at the delayed 13F in a vacuum. It overlays that historical filing with real-time options market data, current SEC Form 4s.
What are Form 4s again?
Those are mandatory disclosures when corporate insiders, like CEOs or CFOs, buy or sell their own company's stock.
Okay, so it sees the CEO buying.
Right, and it combines that with live sentiment analysis. The AI synthesizes the delayed billionaire data with real-time insider behavior to formulate a thesis on whether that trade is still actually viable today.
I picture it like having a team of Goldman Sachs analysts sliding a thick, perfectly organized dossier across your desk in the morning. It's got all the filings, the risks, the projections, and the historical context.
Exactly.
But at the end of the day, you are the boss. You have to read the dossier, decide if you actually believe the thesis, and physically push the button to buy the stock yourself.
That is the absolute perfect visualization of a research platform. Now, if we move to flavor number 2, we encounter the signal and scoring tools.
Right, the second category.
If a research platform hands you a comprehensive dossier, a signal tool basically just hands you a shortcut.
They compress the data. They take all those fundamentals, the 13Fs, the sentiment, and they smash it down into a single digestible metric. Like giving a stock a simple score from 1 to 10, or pushing a daily buy or sell alert straight to your phone.
Yes. The output here isn't a thesis you have to sit down and read over coffee. It's a binary action you can take instantly. It's designed for someone who does not want to read the dossier, but simply wants the bottom line conclusion.
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
I actually tried one of these signal tools a few weeks ago as a test for this deep dive.
Oh, really? How did it go?
Well, I was standing in line at a coffee shop, just waiting to order, and my phone buzzed with this urgent push notification from the app. It was a bright red alert telling me to sell a specific tech ETF immediately because momentum had shifted.
I can imagine how that felt.
It was awful. The sheer anxiety of getting that alert in public while holding a latte completely threw me. It sounds convenient, but relying on a shortcut requires an immense amount of blind trust in whatever black box is generating that alert.
And that anxiety you felt, that visceral reaction, is exactly why you have to be so careful with signal tools, because you are outsourcing your conviction.
Outsourcing your conviction, that's a great way to put it.
When you do the research yourself, you know why you own a stock. You understand the business. So you can stomach a temporary drop in price.
Right, you have a thesis.
But when an app just pushes a red sell button to your screen without context, you are highly susceptible to panic.
Which brings us to flavor number 3, where things get even more intense. Trader platforms. These are built for auto execution.
Yes, and we need to be very clear about who these are for. These platforms are strictly for active day traders and quantitative strategists.
Not for the casual investor.
Definitely not. They automate the charting, they constantly scan the entire market for specific technical momentum setups, and crucially, they execute the trades dynamically. The output here is an automated setup and execution. The machine actually pulls the trigger for you.
So if someone gets these 3 flavors confused, if they mix up a research dossier with an auto execution bot, what actually happens?
You induce the exact kind of behavioral panic we established ruins portfolios.
We're back to the psychology.
Always. A long-term buy-and-hold investor who is saving for a retirement that is 30 years away does not need a hyperactive momentum scanner firing alerts at their phone at 9:31 a.m. every morning. It will drive them insane.
I got stressed just at the coffee shop.
Exactly. And conversely, a day trader trying to scalp a few cents off intraday volatility does not need a tool that spits out 10-year fundamental SEC histories. It's the wrong tool for the timeline.
Okay, so we're handing the keys of a self-driving car over to an algorithm. But what happens when the algorithmic GPS is just fundamentally wrong? Let's enter the danger zone and talk about that terrifying 35% failure rate we brought up at the start.
Yes, we have to unpack this.
Because if I'm trusting a machine with my life savings, a 1 in 3 chance of it being totally wrong is, frankly, unacceptable.
It is absolutely unacceptable, and it is essential we dissect this because the risks are heavily obscured by very slick user interfaces. The independent testing statistic states that general chatbots gave wrong or misleading answers to roughly 35% of finance questions.
How does that mechanically happen?
Yeah.
We assume these AI models have read the entire internet. They know everything. Why are they failing basic math or misinterpreting a balance sheet?
It comes down to understanding what a general-purpose large language model, or LLM, actually is. Think of the standard, everyday versions of AI chatbots you use.
Like the famous ones everyone plays with online.
Right. They're not databases of facts. They are highly advanced predictive text engines.
Like the autocomplete on my phone's keyboard, just on steroids?
Precisely that. The model does not conceptualize math. It doesn't know that 2 + 2 = 4. It simply calculates that the token 4 has the highest statistical probability of following the tokens 2 + 2 is.
That is wild to think about. It's just guessing the next word.
Its primary directive is to generate text that sounds conversational, plausible, and confident.
So if I ask it to analyze a really complex corporate debt restructuring, and it hasn't seen enough training data on that specific company,
it will guess. And because it is designed to sound authoritative, it will string together financially plausible sounding words like amortization, liquidity, and covenants into a sentence that looks incredibly convincing but is completely fabricated.
Wow.
It hallucinates a reality to appease your prompt.
It's basically the guy at a dinner party who doesn't actually know anything about macroeconomics, but he uses big words with such absolute, unwavering confidence that everyone at the table just nods along and believes him.
That is a perfect description.
Huh?
But a purpose-built financial platform tool is designed specifically for investing. They operate on a fundamentally different architecture to prevent this.
How so?
They don't rely on the LM to generate the facts. They are hard-coded to pull raw data directly from verified financial pipes, like the SEC's EDJR database or direct stock exchange feeds.
Okay, so they have a real data source.
Exactly. The platform verifies every single figure against the underlying raw data before it passes that information to the AI to summarize. In these specialized tools, the AI acts strictly as the conversational interface, not the source of truth.
Okay, so the core lesson there: do not use a generic chatbot to plan your retirement.
Please do not.
But our sources highlight deeper structural risks, even with the good purpose-built tools. Let's talk about overfitting. If I'm an everyday investor, what does that actually mean?
Overfitting is a classic and highly dangerous data science problem. Imagine a student preparing for a massive final exam. Instead of actually learning the underlying concepts of physics, the student just memorizes the exact answers to last year's practice test.
Ah, they know that question 3 is always C.
Right. And if you give them that exact practice test again, they score 100%. They look like a total genius. But when they sit down for the real exam, the teacher has slightly reworded the questions and changed the variables.
And the student fails.
Spectacularly, because they didn't learn the rules, they only learned the historical pattern.
And how does that translate to an AI trading algorithm?
Let's say you use an AI to build a trading strategy, and you train it on market data from the last 10 years. Broadly speaking, the last decade has been a massive historical bull market, heavily driven by zero interest rates and booming tech stocks.
Right, easy money.
So the AI analyzes that data and concludes that the absolute optimal strategy is to buy every single dip in the tech sector on maximum margin. It overfits its logic to that specific sunny environment.
It basically thinks stocks only go up because in its entire lifespan of training data, they basically did.
Exactly. Then the macroeconomic regime flips. We enter a prolonged bear market, inflation spikes, or a geopolitical crisis alters supply chains. Suddenly, the environment has changed, but the AI is still operating on the practice test.
Oh, man.
The strategy that the AI is mathematically certain is flawless begins executing trades that just completely destroy your portfolio. The machine is optimized for a world that no longer exists.
That is a terrifying blind spot. The machine doesn't know the weather changed outside.
It doesn't look out the window.
What about latency? The sources mention that retail AI data feeds can lag behind Wall Street, which, that sounds like an unfair fight from the jump.
It is a fight governed by the laws of physics. Wall Street institutions spend billions of dollars laying proprietary fiber optic cables and physically locating their server farms as close to the stock exchange data centers as humanly possible.
To save what? Milliseconds?
Microseconds. Millionths of a second. They are shaving microseconds off their trade execution times.
So if I'm sitting at home using a consumer-grade AI trading bot on my Wi-Fi router in the living room,
your data feed is inherently delayed. Think about it. The data has to travel from the exchange to your broker, through your internet service provider, to your router, to your phone, to your app.
that's a lot of hops.
If your AI identifies a momentary pricing inefficiency in a stock, by the time your app registers it and sends the signal all the way back to execute the trade, the institutional Wall Street algorithms have already bought the stock and closed the gap.
They beat me to it.
Every time. Your supposed algorithmic edge is completely muted by the physical distance your data had to travel.
It's literally like showing up to a gold rush 3 days after everyone else, and all you have is a plastic shovel.
Pretty much.
So latency is a major risk if you are trying to be an active millisecond day trader. But there are behavioral risks too, right? Because the sources spend a lot of time warning about complacency.
Yes. When you delegate everything to an algorithm, it naturally dulls your own critical thinking. If the app sends you a buy signal every morning and the stock goes up for 3 weeks in a row, you stop asking why.
You just get used to winning.
Right. You stop checking the fundamentals. You outsource your vigilance.
And when the app is eventually wrong, and because of overfitting or hallucinations, we know it will be wrong at some point, I'm completely unequipped to understand what happened or how to fix it.
You become a passenger in a crashing plane with absolutely no idea how to fly. And the insidious flip side of that complacency is overtrading.
Let me guess. People download these incredibly powerful tools, they pay a monthly subscription, and they feel like they need to be pressing buttons every single day just to justify the cost of the app.
Which is the fastest way to destroy compound returns. Constantly tweaking your AI automations, changing the parameters every week, jumping in and out of positions because the AI flagged a minor sentiment shift.
It's exhausting just hearing it.
It racks up transaction fees, it triggers short-term capital gains taxes, and it completely defeats the purpose of long-term investing. You are just manually recreating the anxiety the tool was supposed to eliminate in the first place.
So with all these landmines hallucinations, overfitting, latency, complacency, overtrading, how do we actually protect ourselves? Because listening to this, I can easily see someone throwing their hands up and saying, I'm just going to stick my money in a mattress. I shouldn't touch this at all.
Well, you don't avoid the tools. You build strict guardrails around them. First, keep a manual stop-loss discipline.
What does that mean in practice?
This means you decide in advance before you ever buy the stock, if this investment drops by 10%, I am selling, regardless of what the AI says. You hard-code your risk tolerance.
You set the rule, not the machine.
Exactly. Second, you cross-check signals. If an AI alert tells you a company is a screaming buy because of positive sentiment, take 5 minutes to go look at their actual quarterly revenue growth yourself.
Trust but verify.
Do not follow the machine blindly. The AI is a tool to generate ideas, not a dictator that commands your capital.
Trust but verify. I feel like that needs to be tattooed on the arm of anyone opening a brokerage account in 2026.
It's good advice.
Okay, we've covered the categories, we've walked through the minefield of risks, and we know how the tech actually functions. Let's get to the practical application. A guided tour of the actual top tools dominating the market right now, based on our independent testing sources. Let's start with the tools for the researchers. The fundamental nerds who want that Goldman Sachs dossier.
The standout in the mobile research space is a platform called Barebone AI, and what makes Barebone unique is its pedigree. It was built by a coalition of ex-bankers from Goldman Sachs and former robotics engineer.
Wall Street financial modeling meets Silicon Valley automation. That sounds potent.
It's exactly the synthesis you want. The sources detail that Barebone has over 20 specialized skills. It tracks the SEC Form 4 insider trading we discussed earlier, sending you alerts when a CEO is quietly dumping their own stock.
Oh, I'd want to know that.
Absolutely. It analyzes earnings calls using prediction market odds to gauge the true probability of a company hitting its targets. And the user base loves it. It carries a 4.8 out of 5 rating on the app stores.
But looking at the constraints in the notes, it lacks a desktop terminal. It is strictly built for your phone. And crucially, it doesn't execute trades.
Right. It forces you to make the final decision. It compiles the research, but you have to open your brokerage app and make the trade. Now, if you want that level of depth, but you prefer sitting at a desk with multiple monitors, the counterpart to look at is Fiscal.ai.
Okay, what does Fiscal do differently?
This is a desktop-first platform that aggregates over 20 years of financial histories and 15 years of key performance indicators for global companies. It is arguably the premier tool for deep historical fundamental analysis.
Okay, so Barebone for mobile triage, Fiscal for deep desktop history. Got it. Now let's pivot to the signal seekers, the people who just want the shortcut. Our sources highlight Prospero.ai, which caught my attention immediately because it is a free tool.
Prospero.ai is fascinating because of its scale. They claim to crunch over 100 million data points using 10,000 distinct machine learning models to generate their daily signals.
Okay, stop right there. 10,000 machine learning models. What does that actually mean? How does a model weigh a fundamental factor like a company's price-to-earnings ratio against something abstract like sentiment on a social media forum?
It's complex, but each of those models is essentially a miniature algorithm trained to look for one specific correlation. One model might exclusively track how often a stock is mentioned on social media alongside positive emojis.
Like rocket ship emojis.
Exactly. Another model might strictly look at the ratio of a company's short-term debt to its cash on hand. Prospero aggregates the outputs of all 10,000 models.
And then it just averages them out.
Sort of. If the social media sentiment model is screaming, buy, but the debt-to-cash model is flashing a massive red warning sign, the overarching system weighs those conflicting signals based on historical accuracy to spit out a final score.
And they report some very aggressive performance metrics based on that system. A 12.9 times outperformance of the S&P 500 and a 67% four-year average beat on their newsletter picks. But, whenever I hear free tool and massive outperformance in the same sentence, my spidey senses start tingling. How can they give that away for free?
Your skepticism is warranted. The sources note that while the daily signals are free and they serve as a lead generator for their paid premium newsletter, their massive outperformance claims are self-reported.
Ah, not audited.
Right. They are not independently audited in the way a heavily regulated mutual fund would be. It's a highly powerful, zero-cost signal feed, but you have to size your trust to the evidence.
Use it as one data point in your mosaic, not the gospel truth.
Precisely.
There's another signal tool in this category called jargon-free. I like this one specifically because of how it handles transparency. They provide a 1 to 10 score based on the probability of a stock beating the market over the next 3 months, but they actually show their work. It's what the industry calls explainable AI.
Which solves the dangerous black box problem we discussed earlier. If jargon-free gives a stock a 9 out of 10, you aren't just left guessing why.
You don't have to just trust the machine blindly.
Right. You can click into the score and see exactly which fundamental metrics, technical indicators, or sentiment shifts drove that rating. You can interrogate its logic. If it says a stock is a buy purely because of a sudden spike in social media mentions, but you see the underlying revenue is collapsing, you can manually override the AI's conclusion.
That's a huge feature. Okay, let's move into the fast lane. The active traders and the quants. These are the tools that actually execute the trades. The heavy hitter in the sources is Trade Ideas.
Trade Ideas is a veteran platform in the quantitative space. Their AI, nicknamed Holly, scans millions of technical setups in real time during market hours.
While the market is open.
Yes. It is hunting for specific momentum shifts, volume spikes, and complex chart patterns, and it integrates directly with your broker to automatically execute the trades.
But I'm looking at the pricing tiers in our sources, and I have to push back here. Trade Ideas costs anywhere from roughly $1,000 to over $2,000 a year. Why on earth would I pay $2,000 a year when a tool like Prospero gives me signals for free?
It comes back to the physics of latency and the plumbing of the market we talked about. Trade Ideas is paying for direct intraday data feeds from the exchanges. They are providing institutional-grade scanning that fires off in fractions of a second.
Okay, so it's way faster.
Much faster. Prospero is giving you an end-of-day macro signal. If you are a passive investor buying ETFs for retirement, paying $2,000 for Trade Ideas is a complete waste of capital. But if you are a dedicated day trader where a 1-second delay in execution costs you $500 on a volatile trade, you are paying for the specialized infrastructure.
You're paying for the premium fiber optic pipes.
Exactly.
Another tool in the execution category that blew my mind is Composer. This is built around a completely different philosophy. It's a no-code AI strategy builder.
Composer is really democratizing quantitative analysis. It allows you to type out a strategy in plain English.
Give me an example of how that works.
For example, you can literally type, if the S&P 500 drops more than 2% in a single day, sell my tech stocks and buy treasury bonds. Otherwise, hold a leveraged tech ETF.
Just type that sentence.
Yes. And in 60 seconds, the AI translates your English sentence into a fully back-tested algorithmic trading strategy. And it currently powers over $215 million in daily automated trades.
That is wild. You don't need a PhD in Python or computer science to build a trading bot anymore. But again, doesn't the risk of overfitting apply heavily here? Just because I typed out a strategy that backtests beautifully over the last 5 years of a bull market doesn't mean it will work tomorrow when inflation spikes.
You've hit the nail on the head. Past performance is not indicative of future results, and that danger is magnified tenfold when an AI is relentlessly optimizing a strategy to perfectly fit historical anomalies. You can easily build a bot on Composer that looks invincible in a backtest, but instantly loses money in live markets.
Okay, let's bring this entire conversation back down to earth for the rest of us.
Yeah.
The hands-off beginners. The people who don't want to build algorithmic bots or pay thousands for real-time data feeds. They just want the AI to do the boring work in the background.
For beginners, Interactive Brokers, or IBKR, is a major standout because they have integrated an AI assistant called Ask IBKR directly into their platform at no extra cost. It serves as a natural language portfolio assistant.
So instead of digging through 10 different menus to find my account analytics, I just talk to it.
Exactly. You can literally just type, what is my total exposure to the semiconductor sector? Or how much did I pay in commissions last year? And it instantly calculates and visualizes the answer. It removes the profound intimidation factor of a traditional, complex brokerage interface.
I love that. It lowers the barrier to entry. We also have the classic robo-advisors in this category, Wealthfront and Acorns. These companies have been around for a while, but they are heavily utilizing AI under the hood now.
Wealthfront is the perfect example of AI doing the quiet, unglamorous work we talked about at the very beginning. Their algorithm relentlessly harvests tax losses throughout the year. According to the data in our sources, this automated optimization generated an estimated 1.8 percentage points of additional after-tax alpha for their users in 2024.
Okay, let's define alpha real quick for anyone who isn't deep in finance jargon.
Yeah.
Because it sounds cool, but what is it?
Alpha is essentially the excess return of an investment relative to the return of a benchmark index. If the broader market goes up 10% and your portfolio goes up 12%, you generated 2% of alpha. It is the holy grail of investing.
And Wealthfront is generating almost 2% of alpha, not by picking better stocks, but just by perfectly optimizing taxes in the background. That is the real magic of AI for everyday people. And then Acorns uses AI to optimize how it invests your spare change from daily purchases, which is a brilliant behavioral trick for building consistency.
It really is. And finally, in the social investing space, you have platforms like eToro and Rockflow. eToro uses machine learning to cluster thematic investments into smart portfolios, like dynamically grouping a basket of global driverless car companies, and allows you to automatically copy the trades of top-performing human users. And Rockflow features an in-app bot called TradeGPT that answers simple onboarding questions for beginners and allows you to buy fractional shares starting at just $1 single.
It's gamified, it's colorful, and it basically removes every excuse you have not to start. So we've covered the entire spectrum. The thousands of dollars a year day trading platforms, the deep research dossiers, and the $1 spare change apps. But how does a listener, especially someone brand new to this who is feeling overwhelmed by all these options, actually begin today?
The sources outline a highly practical 7-step playbook for beginners. It strips away all the technological hype and focuses entirely on the mechanics of safe adoption.
I love a good blueprint.
Yeah.
Let's dig into step 1. What is it?
Step 1. Clarify your goals and your risk tolerance. And do it in one plain language paragraph. Before you even download an app, you need to answer. When do you actually need this money? Is this capital for a house down payment in 3 years, or is it for retirement in 30 years?
Why is writing it down so important?
Because if you don't define your time frame, the AI cannot optimize for you.
That makes sense. Because if I need the money for a house in 3 years, I should be in guaranteed high-yield savings or short-term bonds. I shouldn't be in high-risk tech stocks no matter what a machine learning signal tool tells me. The timeline dictates the tool. What's step 2?
Step 2. Choose a straightforward setup. Favor broad market exposure, like a classic 60-40 mix of total stock market index funds and bonds, and prioritize transparent fees. Do not start your investing journey by letting an AI day trade leveraged options for you. Start broad, start simple, and build a foundation.
Which naturally leads to step 3. Start with a small test. I think this is the most critical piece of advice in the entire stack of sources.
Absolutely. Only commit $50 to $100 to start. Or better yet, use a paper trading demo mode if the app offers one. You need to observe how the automation actually behaves when the market moves.
See it in action.
Right. Does the AI trade more frequently than you expected? Do the transaction fees eat into that small balance?
I compared to test driving a car. You wouldn't sign a lease without turning the steering wheel and hitting the brakes. Don't hand over your life savings to an algorithm without watching how it reacts to a violently red day in the market. Step 4 is about consistency, right? Set automatic contributions.
This is where you leverage the machine's best behavioral feature: routine discipline. Consistency will always beat big, speculative bets. Set up a monthly transfer from your checking account and let the AI automatically allocate it without you having to log in and look at the prices.
Set it and forget it. Keep your hands off the wheel. Step 5 is establishing a benchmark.
You need to know if the AI is actually earning its keep or just charging you fees to underperform. Compare the AI's net performance, after all fees and taxes, to a simple low-cost baseline index, like an S&P 500 ETF, over the course of a full year.
So if my fancy AI is losing to an index fund,
if your highly complex AI tool is consistently underperforming a brainless index fund, you need to fire the AI.
good point. Step 6 takes us right back to the coffee shop anecdote in human psychology. Review, don't overreact.
If the AI tool flashes a red warning and flags a systemic risk in your portfolio, do not automatically panic and liquidate everything. Read the warning, check if it aligns with your long-term 30-year plan, and sleep on it. Give your prefrontal cortex time to engage before you click a button.
Sleep on it. The ultimate low-tech defense against algorithmic panic.
And finally, step 7, adjust over time.
Your life circumstances will change. You'll get a new job, have kids, or buy a house. Your risk tolerance will shift. You must revisit your plan annually and manually adjust the inputs you give the app. The AI is a partner. It only knows what you tell it.
Okay, let's unpack why these 7 steps actually matter, because here is where the story gets incredibly interesting. I want to look at the sheer math of compounding, because our sources mapped out a real-world example that strips away the hype and just shows the mechanics of money.
The math is where the truth of investing always lies. Let's say you start with $0. You decide to contribute $200 a month for 30 years. And let's assume a historical average return of 7% a year. At the end of those 30 years, you have roughly $243,000. Boom, the magic of compounding.
It's beautiful, but we have to factor in the cost of the technology. The servers aren't free.
Right, so you decide to use an AI tool to manage this, and the app charges a 0.25% annual management fee. Your net return drops from 7% to 6.75%. That $243,000 drops into the mid-230,000s. You just paid out nearly $10,000 in fees over 30 years just to have the app. When you hear that isolated number, it sounds like using AI is a terrible deal.
This raises an incredibly important point because fees absolutely act as a constant compounding drag on your portfolio. Wall Street gets rich on tiny fees. However, we have to look at the other side of the ledger. We have to factor in the behavioral alpha.
This is the kicker right here.
If that AI tool, by automatically rebalancing your portfolio, by relentlessly harvesting those tax losses, and most importantly, by slapping that donut out of your hand and preventing you from panic selling during a massive market crash, if it manages to nudge your actual realized behavioral return up by just 0.5% a year.
Just half a single percent.
That tiny behavioral improvement radically alters the math. It completely eclipses the 0.25% fee, and it adds tens of thousands of extra dollars to your final balance over those 30 years. Small advantages, consistently applied without emotional interruption, compound into massive wealth.
So what does this all mean for you listening right now? Let's synthesize everything we've pulled from this massive stack of data, app reviews, and independent testing. AI investing apps are undeniably powerful tools. They can process 700,000 pages of data in seconds using natural language processing.
They're incredible processors.
They can enforce relentless, unemotional discipline when you are panicking. And they are actively leveling the playing field, giving everyday retail investors access to the kind of quantitative analytics that used to be locked behind the doors of Goldman Sachs.
But they are not magic. They are not crystal balls that can see into the future. They are strictly co-pilots. They cannot predict a global geopolitical crisis. They suffer from physical latency limitations. They can hallucinate false data. And they absolutely cannot fix a fundamentally broken, hyperactive financial strategy.
Exactly. It is still your money on the line. It is still your fundamental plan. And it is still your patience that will generate the real wealth. You have to be the one flying the plane.
And as you navigate this new landscape, it's crucial to remain vigilant. Match the tool to your actual timeline. Don't pay thousands of dollars for real-time momentum scanners if you're passively saving for retirement. Beware the hallucinations of general predictive text chatbots, and always cross-check the signals you receive from black box models.
Trust but verify everything.
The machine is only as good as the human managing it.
Before we wrap up, there is one last entirely unscripted idea that has been bouncing around in my head while looking at all these sources. A thought experiment for you to mull over as you go about your day.
Oh, I'm intrigued. What's the thought experiment?
We spent this entire deep dive talking about how powerful these AI models are at ingesting data to find an edge. But think about this structurally. What happens in 5 years when these advanced AI algorithms become so cheap and so universally accessible that literally every single retail investor and every institution is using one?
Okay, I see where you're going.
If every AI model on Earth is looking at the exact same 700,000 PDF pages, the exact same SEC filings, and the exact same historical data points to calculate the absolute mathematically optimal trade, don't they eventually all arrive at the exact same conclusion at the exact same millisecond?
That is a profound systemic risk. It's the ultimate extreme of the efficient market hypothesis. If everyone has the answer key, there is no advantage.
Will these algorithms eventually just start trading against each other in this massive instantaneous echo chamber? What happens to the stock market when an AI is just trying to outsmart another AI and they both have access to the exact same information?
It becomes a paradox.
Right. Is it possible that in a market completely dominated by perfectly logical, emotionless machines, the ultimate human advantage ironically becomes doing the one wildly illogical, unpredictable thing an algorithm would never expect?
That is a brilliant and slightly terrifying concept to leave on. The idea that human irrationality might become the final edge.
Something to think about the next time your app sends you an urgent push notification. The dashboard might be full of green arrows and mathematically perfect forecasts today, but the murky, unpredictable waters of human behavior are still waiting just beneath the surface.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.